Welcome back to the deep dive. We're here to help you cut through all the noise and really understand the complex world around us. Our whole goal is just to make sure you feel well informed, but without getting totally overwhelmed. And today we've got a pretty fascinating deep dive plan. We're going to zero in on three uh, big areas that touch on pretty much everything from the global economy right down to your own personal finances. Okay, so first up, we'll explore how the rest of the world really views U.S. trade negotiations, especially when it comes to things like tariffs and those big investment deals. Then we're going to look into the, well, surprising resurgence of gold. It's becoming a really critical asset in today's, let's face it, unpredictable economic climate. We'll see how it stacks up against other investments you might be thinking about. And finally, we'll dive into something often overlooked, the psychology behind it all, the factors that really drive investment success or sometimes, yeah, failure right in your own portfolio. So let's start unpacking this global view on trade. Yeah, when it comes to U.S. trade deals, it seems pretty clear other countries aren't just, watching passively. They're actively benchmarking and reacting to how the U.S. negotiates. We see this really clearly with South Korea, actually. They've been watching that U.S.-Japan tariff agreement very closely.
That's exactly right. South Korean Finance Minister Koo Young-kil even said publicly that Korea is aiming for similar terms to what Japan got. They're specifically looking at how Japan managed to get those auto tariffs lowered, from 25% down to 15%. And this isn't just like a casual thing. It's a direct response to some very real concerns they have about their own auto industry's competitiveness under the current U.S. tariffs. They're looking for a level playing field, basically.
Okay, and speaking of Japan, their own press and government had, well, quite a reaction to the initial reports about their deal, didn't they? Some media outlets were pretty sensational, portraying it like Japan was just handing over money to the U.S. Some even claimed, 90% of pure profit?
Yeah, that was certainly an interesting gap between public perception and the actual deal terms. Japan's government pushed back pretty quickly on that narrative. They clarified that any profit sharing was based on, quote, mutual contribution and risk, not just some kind of handout. And, the actual contracts and most observers looked at that 90% figure and thought it was, well, an overstated interpretation. Think of it like a potluck, maybe. If one person brings a huge fancy dish and someone else brings like a small bowl of chips, well, sharing the leftovers based on who brought what isn't really giving away 90% if the contributions were just vastly different to start with. It's about who put in what.
That makes sense. Okay, so let's shift over to Europe. They also recently got a trade agreement with the US, tariffs lowered to 15% there too. It seemed like EU companies were really emphasizing the stability aspect, removing those additional tariff risks. That seemed like a big win for them.
Well, yes and no. While that stability was definitely welcome, the reactions inside Europe were actually a bit mixed. You had some, like a member of the European Parliament's Trade Committee, calling the deal the best possible for Europe. High praise. But on the flip side, other industries and lawmakers were more critical. They pointed out that certain things, especially cars, still faced potential changes in U.S. tariff policy. So that kept some uncertainty alive.
Huh. So it sounds like there's a bit of a pattern emerging here. Foreign analysts, experts, they generally seem to critique the U.S. approach, right? Words like too powerful pressure, even coercive, keep popping up when describing how the U.S. negotiates with allies. They keep stressing procedural fairness and mutual benefit.
And that criticism seems particularly relevant for South Korea. Many observers think Korea is at a clear disadvantage compared to Japan and the EU, especially when it comes to investment conditions and these profit-sharing terms. The demands from the U.S. on Korea are reportedly higher, tougher public conditions, too. Analysts point specifically to things like Korea maybe being less prepared than Japan in managing forex risk, that's foreign exchange risk, also diplomatic stability, and just coordinating the sheer size of investments. Korean officials themselves have even mentioned Japan's bigger foreign exchange reserves and, greater flexibility in currency policy as key differences.
Okay, so the overall take from abroad seems to be that U.S. methods in these tariff talks are often seen as, well, dominant or even coercive. What's the bottom line here for someone listening?
I think the key takeaway is this. The U.S. is very effective at using its economic power in these negotiations, no doubt about that. But that approach often creates this perception of coercion among allies. Still, despite that criticism, there's also a kind of pragmatic view. Engaging with the U.S., getting that trade access, avoiding protectionist pressures, it's still seen as a necessary or realistic choice for many countries. It's a really complex dance.
That global picture definitely makes you think about your own financial security, doesn't it? So let's pivot now to a really key part of personal investment strategy, gold. And this is where it gets really interesting, I think, because gold's role seems to be changing quite dramatically.
Oh, absolutely. Gold's growing importance right now is uh, hard to overstate. It really functions as a vital inflation hedge and a strong defense against currency devaluation.
Mm.
Think about it. When real interest rates are low or negative, meaning inflation is eating away at your savings faster than the interest you earn, money naturally flows out of cash and into real assets like gold. And historically, there's a strong link. Gold prices tend to rise roughly in proportion to a nation's currency supply over time. You could maybe picture gold like a really sturdy umbrella in a financial downpour. It protects your purchasing power when cash itself is just getting soaked by inflation.
That's a great analogy, and it makes sense because it sounds like gold's standing as a safe haven asset is actually getting stronger,
Mhm.
especially when you think that the US dollar, which was historically the safe haven, seems, well, a bit least reliable recently.
Precisely. There's a whole mix of factors kind of eroding trust in the dollar right now. We're seeing questions about the Federal Reserve's independence, rising geopolitical tensions, and frankly, unpredictable political situations. The actions of President Trump, for example, can definitely influence global economic sentiment. And we also just can't ignore the serious impact of rising U.S. national debt and the burden of high-interest refinancing. That really challenges the dollar's credibility on the world stage.
Wow. Okay, so this all suggests gold might have some serious long-term upward potential. It really makes you think back to the 1970s, right? That period of high inflation, high debt, gold prices surged, what, 26-fold back then? Today's conditions feel kind of similar.
They do share some striking similarities, and there are even extra drivers now. For one, the sheer number of investors who can actually access gold today has increased dramatically, like 18-fold compared to before. Plus, you have these new tokenized gold investments popping up, making it even easier to buy, which could potentially lead to an even bigger price increase down the line.
And it's not just individuals buying gold, is it? There's this key trend of central bank gold purchases really picking up steam. Ever since the 2008 financial crisis, central banks around the world have pretty consistently bought more gold than they've sold, hitting record highs since 2021.
And that their motivation is very strategic. It clearly reflects declining trust in the dollar, yeah, but also a strong desire to diversify, especially diversifying against potential economic sanctions. Think about things like swift sanctions cutting a country off or foreign exchange reserves being frozen. Gold offers a tangible, independent asset outside that system.
Right, which brings us to gold's basic nature. Its scarcity and inelastic supply. It takes, what, about 10 years from finding gold to actually refining it, which means when demand suddenly surges, supply can't just instantly ramp up. That leads to these long super cycles where prices can climb for a decade or more, and estimates suggest remaining reserves are finite, maybe only 10, 20 years left. The current cycle started around 2019.
Yeah, believed to be about midway through. But it's really crucial we also talk about gold's risks. Because despite its safe haven reputation, you can see short-term sharp declines. We saw it in 2008 during the IMF crisis, during COVID. It happens because of what's called a cash-out phenomenon. In a real panic, investors sell everything, even gold, just to get liquid cash. Plus, its price is definitely influenced by the Federal Reserve's monetary policy, which can cause volatility.
Okay, but hang on. If gold is a safe haven, isn't that kind of short-term volatility a big contradiction for someone looking for stability? How do you square that circle for an investor?
That's a really important point. And safe haven doesn't mean zero volatility, not at all. Gold's strength is protecting purchasing power over the long term, especially against things like currency devaluation and inflation, those short-term drops. They're usually these broad liquidity events where, like I said, all assets get dumped in a panic. But once that initial shock wears off, gold often bounces back because its fundamental role as that hedge against systemic risk comes back into focus. So yeah, it's really a long-term play, not something you trade day to day.
Okay, that clarification helps a lot. So bearing that nuanced role in mind, how does gold compare to other assets someone might be considering for their portfolio right now?
All right, let's break it down. If you look at the dollar and bonds, their traditional role as safe havens has, well, definitely diminished. You've got risks like inflation, questions about Fed independence, geopolitical instability, unpredictable political factors like President Trump potentially adding uncertainty. All these things make people less confident. Plus, with low or even negative real interest rates, bonds just aren't very attractive. Your returns often don't even keep pace with inflation. Now, stocks and other risk assets, sure, they offer potentially high returns when the economy is growing, but they're incredibly vulnerable to recessions, geopolitical shocks, political uncertainty, Sudden policy shifts, maybe related to the president, can spike anxiety and send money fleeing from risky assets toward perceived safety. Even gold mining stocks, while obviously linked to gold, still carry all the inherent risks of the stock market itself. They can get hammered in a broad market downturn. And then there's Bitcoin, often called digital gold, right? It is emerging as a new kind of asset. It offers things like anonymity, portability for moving assets, especially maybe during smaller conflicts.
But it comes with its own set of risks. There's transparency. The blockchain records transactions, so it's not totally immune to state sanctions like SWIFT, unlike, say, physical gold you hold yourself. Its limited uses are another factor. It's mainly for investment or exchange, unlike gold, which has industrial and jewelry demand too. Bitcoin also has a very lack of history compared to gold's, 5,000 years as a store of value. It often behaves more like a speculative, risky asset, sometimes moving with gold, but often driven by liquidity flows like other tech stocks. And, in a really large-scale conflict scenario where things like currency issuance and major inflation become critical, gold's historical, tangible role would likely overshadow Bitcoin's quite significantly.
Okay, that's a really comprehensive comparison. So, given all of that, what's your best advice for our listeners trying to figure out their future investment strategy, especially thinking about gold?
Well, I think it boils down to three really essential points for anyone trying to be an informed investor today. First, portfolio diversification is just absolutely critical. You have to spread your risk. Especially during deleveraging periods, that's when governments are trying to reduce debt, often using inflation to help. That's when you tend to see these gold supercycles kick in. Second, maintain gold holdings. A good rule of thumb is maybe around 10% of your total assets. You might increase that a bit during a supercycle, then maybe decrease it afterwards. And third, you absolutely need a long-term perspective. Gold is a buy and hold asset, think 5 years or more. It's just not suited for trying to make a quick buck through short-term speculation.
So, we've talked global trade, we've talked about the allure of gold, but what does this all really mean for you, the listener? Because ultimately, it seems like your own psychology, your own mindset, might matter even more than the specific asset when it comes to long-term success.
Oh, completely. The importance of self-understanding and investing just cannot be stressed enough. Your actual returns are often determined less by the asset itself and much more by how you react to the price swings after you own it. It's kind of like buying clothes, right? Knowing your own size is essential. The most beautiful dress in the world is useless if it doesn't actually fit you. Similarly, understanding your own investment behavior is crucial. Someone who, say, keeps checking prices obsessively after they sell something, they're probably going to jump back in, maybe again and again, potentially right before a crash. But investors who are more self-aware, they understand that assets shooting up really fast can often lead to bad outcomes. So they might take quick profits, or maybe just avoid those situations altogether.
Yeah, I think we've all been there, right? Constantly refreshing the stock app, feeling that little dopamine hit from a tiny gain. It really can become almost addictive, can it? It sounds like there are a whole bunch of these psychological traps and behaviors to avoid that most of us are prone to.
There really are. One very common one is an excessive desire for profit realization. That feeling, that urge to sell as soon as you're up just 10%, even if the long-term case is strong. Then you have competitive and speculative tendencies. Societal pressure, seeing others supposedly getting rich quick, can push people towards really risky bets. Fixating on short-term price changes is another big one. Checking prices daily, hourly. It can lead to that dopamine overload you mentioned, but also just plain unhappiness and anxiety. And, the obsession with market timing. This is such a dangerous assumption, thinking you can predict the future. Study after study shows over 90% of your investment performance comes down to asset allocation. How you divide your money, timing has almost no impact. Trying to time the market perfectly. It's like trying to catch every single raindrop in a thunderstorm. You might snag a few, sure, but mostly you're just going to get soaked. It's much better to prepare for the whole storm. Oh, and also, chasing popular assets. Remember the old saying, there's no free lunch at the famous market? Often true for a reason. By the time something is super popular, the big gains might already be gone.
Okay, so if we're trying to sidestep all those pitfalls, what are the core principles for success then? How do you build a truly robust personal investment strategy?
Right, so shifting to the positive side. First, and maybe most important, is adopting a long-term perspective and a buy and hold strategy. Think about Peter Lynch's famous Magellan Fund. Huge returns over its life, right? But studies showed over half the investors in the fund actually lost money because they were constantly jumping in and out trying to time it. Many people would literally be wealthy today if they just put, say, $1,000 into a simple S&P index fund decades ago and just did nothing. There's even a grim saying that death's return rate is highest. It's morbid, yeah, but it illustrates the sheer power of just holding on through thick and thin. Second, Focus on a strategy of avoiding wrong answers. Instead of searching for the perfect investment, focus on avoiding big mistakes. Third, really prioritize asset allocation and risk management. Like I said, over 90% of your performance comes from how your assets are divided. Even if you love tech stocks, make sure you balance that risk with safer assets. Fourth, consciously include geopolitical assets. Allocate maybe 10–20% of your portfolio to safe havens, like gold, specifically to protect yourself during turbulent times. And finally, just adopt a long-term humanistic approach. Focus on steady, consistent returns. Prepare for uncertainty rather than getting obsessed with short-term news, trying to time the market, or picking that one magic stock.
Wow, what a deep dive indeed. We've really covered a lot of ground, from the complex global views on U.S. trade to gold's changing and arguably increasing importance in these uncertain times. And maybe most critically, the absolute need to understand your own investment psychology.
Exactly. Being truly well-informed isn't just about knowing isolated facts. It's about seeing the connections between these different areas: trade, assets, psychology, and most importantly, understanding how all that applies to your personal decisions. It's really about building a solid framework for navigating the world, especially your financial world.
Well said. I really hope these insights give all of you listening a clearer perspective, maybe help you feel a bit more confident making decisions about your own financial landscape. So, here's a final thought to leave you with. Given this deep interconnectedness of global trade, the shifting sands of currency values, and let's be honest, our own very human tendencies, how will you choose to navigate this economic landscape to secure your future?